Good afternoon, this is Neil Warren, and today I'm going to consider the record-keeping requirements of making tax digital for VAT that comes into play in April next year. Now, so far I've done two separate sessions, one on the basic issues of MTD. I'll recap on a few of those in the next slide, and also some practical challenges for certain types of businesses. So this is my third session looking at the record-keeping requirements that we need to comply with MTD after April next year. So just to look at some of the key points, and also to just to clarify a few areas where there's been some confusion. The MTD regulations apply to VAT periods beginning on or after the 1st of April 2019, and only for a business that has taxable sales exceeding the threshold at the beginning of MTD, so the 12 months to the 31st of March 2019, and if they're not captured at that point, they need to monitor their annual taxable sales on a rolling 12-month basis thereafter to identify whether they need to come into MTD at the beginning of their next VAT period. So just to give an example there, if you've got a client who does February, May, August and November VAT periods, then the starting point for him or her, as far as MTD is concerned, will be the 1st of June 2019, i.e. the first period starting after 1st of April. If you have clients who voluntarily register for VAT, they can join MTD, and the argument in favour of that is that there is talk about all registrations being captured by the 1st of April 2020, and also to be aware that one of the quirks of MTD is if a voluntary registration goes over the limit in any 12-month period of taxable sales, the annual £85,000 figure, it must join MTD from the beginning of the next period and cannot withdraw even if that blip in turnover going over 85,000 was purely a temporary state of affairs. So, as I've said before, once you're in for good, unless you then deregister at some point in the future. And again, just to clarify there, the myth that charities and not-for-profit organisations are exempt, they're not exempt. Any business over 85,000, whether it's a sole trader, partnership, limited company, club or association or charity, are all captured by the new processes. Now, when we talk about record keeping, just be aware the aim of MTD in probably three key words: minimal human intervention. And the reason that HMRC are looking for this particular outcome is they think it will reduce VAT errors, for example, arithmetical errors and transposition errors that are often made when completing VAT returns. This is a controversial statement they've made about the increase in the tax yield of £1 billion by 2021-22, which many commentators, me included, dispute. But in principle, it is fair to say that if the computer does the work, then you are certainly taking out, hopefully, human errors, if not errors of other types. Record keeping. Let's start with spreadsheets, because I know that this is one of the main areas of concern of advisors. Can a client keep using spreadsheets, and will that be okay as far as MTD is concerned? There was speculation and talk a couple of years ago that spreadsheets would not be allowed as a digital form of keeping records, but HMRC have since U-turned on that, and spreadsheets are fine. The key point with spreadsheets is there will need to be a digital link between the spreadsheet totals, for example, input tax and output tax, through to a 9-box VAT return, which is then sent digitally to HMRC. Now, the key phrase on this issue is bridging software. In other words, the software that bridges the spreadsheet totals digitally to the VAT return process, which then goes off to HMRC. Another phrase you'll hear if you read any articles or analysis is the digital journey from entering a sales or purchase invoice all the way through to HMRC receiving a completely accurate VAT return. Let's just look at a quick example here. So we've got a management consultant, typical service business, doing over 85,000, who needs to join MTD, has a spreadsheet with an output tax total for his quarterly sales and an input tax total for quarterly expenses. He then links the cell with the totals via bridging software to the 9 boxes of the VAT return, of which probably 3 will be blank unless he's trading overseas. And that return is sent to HMRC by a digital link to complete the digital journey. Good news that until April 2020, so 1 year after the inception of MTD, this digital link is not compulsory, and, for example, cut and paste of figures will be acceptable. So effectively it's giving businesses 1 year to adapt to the need to link various parts of the system together. There's plenty of examples of links in HMRC Notice 700-22, how you might have, for example, a group registration with 4 different companies producing their own VAT figures as part of the group registration, and then there must be a digital link between the 4 companies' VAT totals to the master VAT return, which then gets sent to HMRC by a digital process. So there is this year's transition, which is good news. Let's go back to documents, and we'll forget retailers just for the moment. Look at sales and purchase invoices. What do you need to record when you complete your spreadsheets or your accounting software in terms of individual documents? Now, sales invoices do not need to be raised digitally, so you don't need to actually do them on the screen. You can still raise an invoice with a Word document or what other method, but they need to be entered into your record-keeping system digitally, and they must show the time of supply, I'll come on to that phrase later, the net value of the income and the rate of tax for each different part of the sales invoice. So in my notes I've given the example of a sales invoice that consists of the sale of a standard rated pen for £20 and the sale of a book for £10, the latter being 0 rated. So what you would show there is invoice number, time of supply. I've invented the 1st of June 2019, obviously a date after the 1st of April 19. And I'm showing £10 at 0%, my 0 rated book, and £20 at 20%. You'll notice I don't need to actually keep the output tax figure of £4 in the entry, just the rate of tax and the net amount. Different information for purchase invoices. Again, that time of supply, that needs to be recorded. Also, the net amount, which is the total purchase invoice excluding VAT. So you don't need to go down and itemise the invoice if there's, for example, 0 rated elements on it or standard rated or exempt elements. Just the net figure and the input tax that's being claimed, i.e. the VAT that will find its way into box 4 of your VAT return. Let's look at this phrase, time of supply. Often used phrase is tax point. Now notice 700-22 confirms that for cash accounting scheme users, where you account for output tax when your customers pay and claim input tax when you pay your suppliers, the time of supply is the payment date, not the invoice date. If you're not on cash accounting, then it becomes the invoice date rather than the payment date. The timing of record keeping, let's think of a retailer. Let's think of, say, for example, a mobile caterer who keeps a manual book of his daily takings inside his catering van, and at the end of a quarter he has a whole day to do his VAT and accounts, and he goes onto Sage or his software system and literally enters 90 days of daily gross takings. Then he can complete his VAT return. Yeah, that's absolutely fine. There is no obligation to do real-time accounting on this, i.e. entering his daily takings every day. No, the challenge is to be digitally compliant by the time that you prepare and submit your VAT return, and obviously the challenge there is to meet the filing deadline 1 month plus a week after the end of the VAT period. I don't want to go into lots of detail about how you record errors and digitally and partial exemption adjustments, because obviously in most cases a journal can be done to record, for example, your partial exemption annual adjustment or retail scheme annual adjustment. And one of the key things that HMRC have always said, which is probably a fair comment, is that MTD is not changing the record keeping requirements for a business, only the format in which they are kept. So 3 easy examples there. Flat rate scheme users, you only claim input tax if you use the scheme with capital expenditure goods costing more than 2k including VAT. So you need to record those input tax claims digitally, but your other purchase invoices where you don't claim input tax with the scheme, you don't need to record them digitally. Absolutely fine, as would be expected. Antique dealer, for example, margin scheme trader who keeps a second-hand stock book of all the items he buys and the price and sells on to work out his profit margin subject to VAT. The second-hand stock books can still be kept manually. There's no need to process them digitally, which is good news. And retailers, it's always been the case since 1973 that retailers have to record their daily gross takings, not weekly, not monthly, but a daily figure. That remains unchanged. Good news is also for retailers, again, to dispel a myth. If, for example, you've got a coffee shop client, you don't need to record each individual sale digitally, so you can still use a manual 2-button till for selling a pot of tea and a cake for £5 to a customer. That is absolutely fine. You don't need to have it all the way through from transaction to takings to daily takings all the way through. The first point in the audit trail where digital recording is needed for retailers is that daily gross takings figure. Final comment about penalties. Now, I'm not over concerned about penalties. I think in the first year, HMRC will not be looking to go into this with a heavy hand. The light touch phrase has been used in the past on penalties. There has been reports from them and documents that it's going to be based on a points-based system. Sounds a bit like incurring speeding fines if you've got a driving licence where you accumulate points and eventually get a ban. So if you submit a VAT return late, then you get 1 or 2 points, and then once you exceed a certain points threshold, you are into penalties each time you default in the future, unless you can do a period of compliance, possibly a year, when you go back to zero again. It's always been the case that if you put your returns in on time and pay your tax on time, and you can help the payment of tax by, for example, having the direct debit system in place, so it's automatic taken a week plus 3 working days after the following month after the end of that period. If you submit returns on time, pay your tax on time, then penalties will not be a relevant issue. So lots of things to think about. The time flies by very quickly. April 2019 is not too far away, so now is a good time to raise issues with clients. My personal view is that each client needs to be looked at on a one-by-one basis, taking into account their knowledge of digital issues and their commercial knowledge and their accounting knowledge to see the risk factors if they go into MTD for the first time. Just be aware that you can apply to HMRC for exemption from MTD in certain cases. Little bit vague on detail. I don't think they're looking to give many exceptions, but age, disability, remoteness of location for internet access, religious grounds, not using computers, or any other issue. So a little bit of scope there to possibly request exemption in some limited cases. And that concludes this session.